Chapter 5, Money and Inflation. Money is used for three things: store of value, unit of account, and exchange. If I have given my services to someone, I can store that return as part of money, right? So goods and services, it's very easy for us to specialize in an area that we like. We don't have to think about barter system. It is highly efficient in terms of transaction costs are very low. So money overall is not equals currency. Money is a store of value. There's different currencies, right? Every country has their own currencies. Money is a store of value. It's a unit of account. Some money can be stored in dollars. Some money can be stored in rupees, right? So the different currencies can be stored in different denomination. But money helps with efficiency. Like I can sell my goods and services to anyone can sell it to me, and now I have the store that I can use to pay my grocery bills, to pay my electricity bills, or buy a computer. So money is those three things. It helps with those three things. Now, who produces money? So the central banks. In the United States, we have the Fed, the Federal Reserve, the central bank. That is the starting point of pumping money into the ecosystem, which is Federal Reserve lends the money to the banks, banks lends the money to householders, companies, and others. So what is this Federal Reserve made up of? Federal Reserve is made up of 12 regional federal banks, and there is a board of governors, 7 of them, and then from these 12 regional banks, they get five votes in the Federal Reserve Open Market Committee, which is basically they meet every 6 weeks. These 12 Federal Reserve Bank representatives, they meet every 12 weeks, and then there are 7 board of governors. 5 out of the 12 regional bank presidents, they get the right to vote. What are they voting on every 6 weeks? They're voting on how much money to put into the system or how much money to take out of the system, right? So when they buy from a bank a government bond, then they buy the bond, but they give back the money. So now they're pumping money into the system. But when they sell the bond that they have, they're going to take that money back and sell the bond. So government bonds are bought and sold every 6 weeks. The decision to buy and sell, the federal meeting that happens, it's FOMC, Federal Open Market Committee, and it's by these 7 board of governors and 5 out of the 12 regional bank representatives that gets to vote, and then that 5 votes moves between those 12 regional presidents. So they every year there's an annual shift of who gets to vote. So then they get to decide whether they should be buying bonds or they should be selling bonds. What happens with this? When they buy bonds, they are pushing money into the economy, and that is what's going to be part of the money supply. But they also, Federal Reserve also sets an interest rate. It's like at what percentage I'm going to give you that loan, at what percentage am I going to lend you the money. So that is the monetary policies. The Federal Reserve is responsible for the monetary policy, and by that they govern the interest rate. At what percentage will they lend, right? If I buy the bond, I need to tell you, okay, I'll give you the money, but at this percentage interest. So once I've done that, I've set the interest rate, then I, as a Federal Reserve, will issue currency, and then I will monitor all the banks. So those are the 3 things that the Federal Reserve does. It sets the interest rate, and how they set the interest rate, we'll get to that very soon. They provide money, currency into the economy, and they monitor the financial health of the country. And so only recently we have a new big central bank called the ECB, European Central Bank. But Federal Reserve and ECB combined are the 2 big central banks globally. There are many central banks, but these 2 are really big in terms of size and power. One interesting fact, so all of these, the chairman of the Federal Reserve, so the 12 Federal Reserve presidents, and then the chairman. The chairman is elected by, is chosen by the president. So the president chooses who the Federal Reserve chairman is, right? And then that same chairman is what is a chairman for the board of governors. He's the chairman for the board of governors, but he's also the chairman for the FOMC, the Federal Reserve Committee meeting that decides what to do, and then they do it by this voting system, right? So the president has to select the chairman, but the Senate has to, approve. And so that's how the Federal Reserve, the central bank in the US works. And then there's an ECB part of this. So we know what money is, we know who supplies it. And now let's see how aggregate measures of money work. So M1 stands for liquid money, like all the currencies that's in circulation, the checking accounts, travelers' checks, demand drafts, it's all liquid money. Then M2 is M1 plus the saving accounts, the money market funds, the money market mutual funds, and all of that is M2. So the reason why we have aggregate money measures is to find out the relative health. So they typically go in proportion, the percentage of M1, percentage of M2, but there's variation in there. So the Federal Reserve watches this percentage as to how it's doing. But it doesn't really at the moment look at this as the policy driver, it looks at interest rate. One other interesting fact is that in the US, for every US citizen, there's $3,000 in circulation. So people do keep a lot of cash. Where is this cash? I think there could be three places. One is people who deal with cash, right? Maybe they don't want to show that as part of income, so income tax reduction. A lot of criminal activities happen in cash, so those people hoard a lot of cash. A lot of governments outside of the US which have a lot of inflation also handle cash. So they keep, countries outside keep US dollars because it is stable, and so that money is also floating around. So it's quite important to measure this so that the Federal Reserve knows what the health of the economy is. So now that we have some introduction as to what money does, who supplies it, what are the measures of aggregate supplies, now let's look at the quantity theory of money. Quantity of money says M times V equals P times Y, right? So we know P is the price level, Y is the aggregate output, M is the total money supply, and V is the velocity. Like if I have given in the dollar bill today, how many times is this dollar bill spent in a year? If I use that same dollar for purchasing 5 goods, if I sell it to you and you sell it to someone else, then it's 2 transactions. So that dollar went twice. So velocity is basically for a given year, how much does this aggregate money supply move between goods and services? So this quantity theory of money basically says price level times the aggregate output equals money, total money supply times velocity. And this intuitively makes sense. Why? Because the total price times the aggregate output is equal to the income, right? And that's equal to how many times everyone in the economy, the velocity, times the money. How many times the money is moving around. So it's basically quantity theory of money is how much is the money moving around or how much income is being generated, right? P times Y is income. M times V is also like how much income for everyone combined is being generated. So how does this help? Quantity theory of money helps us with 2 things. It helps us with price level. It gives us an equation of price. Price level is basically, think about this as how expensive or cheap a given good is. And it changes over years. So price is equal to money supply times V bar, which is velocity. V bar here stands for V can be considered constant, meaning it's exogenous, it's given, it doesn't change. And Y bar again is its total output doesn't change, right? And we'll see why. But in a sense, money times V upon Y equals P, right? So it's from this equation. So now we have a way to think about price level. So if money supply changes and increases, price level increases, right? So things become more expensive. That's one key takeaway from here. Now, if you want to see the percentage change in V, right? The percentage change in price, then that is equal to inflation. So we know price increases as money increases, there's a direct correlation. Inflation, on the other hand, we can now derive this equation, inflation equals percentage change in money minus percentage change in output. We can derive this equation from this one. Basically, there's some math involved here, but like this, the product of two variables can be written as the sum of percentage change of those variables through math, right? And so if we then consider delta V equals 0, right, then we can get to this equation, which is percentage change in P equals percentage change in M minus percentage change in Y. Because this would be percentage change in M plus percentage change of V equals percentage change of P plus percentage of Y. We get percentage change of V 0 because velocity doesn't change. Then we get percentage change of price level, which is inflation, pi, equals percentage change in the money supply minus percentage change in the output. So this is quite powerful, the quantity theory here. And this all of this applies in the long run, meaning over 10 plus years, I'm guessing. I don't know what the long run really is, but in the book it keeps saying long run, long run, long run, right? So now we have a way to speak about inflation. It says money supply increases, inflation increases, right? So that is quite interesting to know, right? And we've seen in chapter 2, right, the Fisher equation, where interest rate, nominal interest rate equals real interest rate plus inflation. So now we can connect inflation with money supply, but now we can connect money supply, inflation with interest rate. So that's the real significance here. As money supply increases, inflation increases. As inflation increases, interest rate increases. So now we've connected interest rate with inflation and then with money supply. So now, how is all of this connected with the Fed, right? Think about this. If the Federal Reserve expects the inflation to go up, pi E is expected inflation, then they will right now change the interest rate. So this is a leading indicator in some sense. If we find out what the Federal Reserve expects the inflation to be, you look at the bond yields. If they're going up, then expected inflation by all of these economists is going to go up, right? Through the Fisher equation. So now the significance of all of this is now we've tied inflation to interest rate and we've tied money supply to inflation. So money supply is deeply tied to inflation. Increased money supply, inflation goes up, interest rate goes up, right? So that's how all of this is connected. And so how does it matter if inflation goes up, right? So if inflation goes up, there are 5 costs associated with inflation. Number 1, shoe leather cost. Shoe leather cost is basically saying your leather in your shoes will get worn out as you keep going to the grocery store for multiple shopping, or the grocery, because the prices are going up, so you're like getting anxious, so you keep going to the grocery store, and so then your shoe leather cost goes up, right? Your goods and services, you'd use your car to go there, so now you are wearing out your car, you're wearing out all of your capital is being worn out, so that's a cost. Your capital, shoe leather, is just one example, but your time is being lost, your efficiency is being lost, your car is being worn out, your gas is being spent extra. So everything in your capital is being worn out. Second, menu cost, right? If the price of tomatoes is rising like 10% every day, then the pizza shop now has to change the prices because they use tomato sauce. So then they have to constantly advertise for new prices. They have to change their menu, which is printed. So now they have to print a new menu. They have to attract the customers with the new prices, right? Because now they're really surprised that there's a price change. So the menu cost is all the costs associated with changing the menu price, advertising, printing, attracting the customer, and all of that, right? And these are all inflation that are anticipated. Third, tax distortion. If I, let's say, own $1,000 stock today and it becomes $2,000, now I've made $1,000, right? But let's say the inflation goes up 100%, right? It goes from 2% to 4%. So the percentage change is 100%. So my ability, and my stock price also went up from 1,000 to 2,000, so it's 100% change. But with that $1,000 of gain, I can no longer buy extra goods and services. I just lost that $1,000 gain, the 100% gain, to 100% raise in inflation. But I will still end up paying $150 of tax, 15% of $1,000 gain. So for me, I paid tax, but my purchasing power actually went down. So this is also a disincentive for investment, because I feel I'm paying taxes, but my purchasing power goes down. Fourth major cost is variability in relative prices. So let's say I'm a shop that sells shoes. If I set my prices on the 1st of January and inflation is 2%, and then my neighbor he also sells shoes, sets their prices in March, 2 months after me, and then inflation is at that time 4%, right? So they're gonna keep their prices higher. My prices are lower because I didn't adjust it in March, because the inflation at that time, I only looked at inflation in January. So there's a distortion now. Their prices are going to be expensive, mine is going to be cheaper. More customers will come to me. I feel I'm doing better, but it's not the case. I have lower prices, I didn't factor in inflation. So relative pricing becomes hard. How often should you price? How often should you rebalance? It's a headache. So loss of dollar yardstick, right? When people purchase things, they think of dollar as constant. It's very hard for people to do mental math as to, hey, I bought this $20 pizza, now it's $22, so it's a 10% increase. And similarly, when they buy, let's say, a $50 computer, $50 electronic device for, let's say, $100, they think they have just paid 50%, but it's a 100% increase, right? So 10%, 100%, it's very hard for people to do the math. So people then can't use the dollar as a yardstick, like a key measure, like, hey, it was $10, it's now $10, right? So it's same. These are all anticipated costs. But think about all the unanticipated changes in inflation. Let's say the Federal Reserve is expecting the inflation to go up, and so the interest rate goes, but like, let's say the inflation goes up even higher, or it was unanticipated, meaning it was way beyond. Then all of these are exaggerated much more, right? Let's take an example. Let's say the expected interest rate inflation was 5%, and the real interest rate today is 2%. Inflation I expect to be 5, real to be 2. So my nominal interest rate will be 7% based on this equation. If I expect inflation to be 5%, real rate of interest to be 2%, then I will, as a bank, I will borrow someone money at 7%, right? Because I would want to factor in inflation, and I would want to factor in the real interest rate. But now let's say I as a bank, when I was borrowing money, thought of 5% as the expected inflation, but it became 10%. It was unanticipated. Inflation became 10%. Now my interest rate should have been 12% to lend money as a bank. But then I've given people money who was at 7%. And so they actually, the borrower from me made a lot of money. Right? So this is pretty bad, right? Similarly, if I'm into production, I'm building things, I have a factory, and if I see that I'm expecting inflation of 5%, but the inflation becomes 10%, so there's a huge increase in inflation. So what happens? Demand goes down for my goods because it's more expensive. And so when demand goes down, I cut production because I want to match supply and demand. And when I cut production, then I think that I'm reacting to the lower demand, but actually it's inflation that's eating into my demand. And so by the time inflation catches up, my production is low. So now there's more demand for my goods, but I don't even have things to sell. So I overreacted. Similarly, you could underreact, right? So production companies, this is pretty major supply demand characteristic. Even if you have to buy something, if you have to pay someone a salary, if you can't anticipate the inflation, you could either lose out or you would win, but then the other person loses out, right? So there's a huge loss when there is unanticipated inflation, right? So now the final piece is classical dichotomy, right? So we learned about money, how Federal Reserve prints, supplies money, what are the measures, aggregate measures, how the quantity theory of money intuitively makes sense, and how that helps us tie money supply with inflation and with interest rate. And we saw the anticipated issues with inflation, 5 costs, and we saw how unanticipated inflation also has huge costs. Now when all of this is happening, you'll be thinking like, hey, how does this really matter? Like, hey, Federal Reserve is pumping money, let them pump money, right? How does it really matter? That's where we have this classical dichotomy, which basically says that in the long run, there is complete separation between real economy and nominal economy. Because nominal economy goes and is driven primarily through price, whereas the real economy is not really changing, right? Like if the Federal Reserve decides, hey, I'm going to print money, and the money supply goes up, what happens then? Does it really change unemployment? Does it really change the infrastructure that's broken? No, the answer is no. And that's what this classical dichotomy is saying. It's saying that the real economy and the nominal economy, they are out of sync in the long run. And that's what leads to this net neutrality of money, which basically is if you print more money, it doesn't really change the real factors of unemployment, real factors of output, real factors of infrastructure. None of that changes. So it's saying that the dichotomy states that they differ, and net neutrality is basically saying that, hey, this extra money doesn't really it's neutral. It doesn't really make a difference. And let's take an example to understand if it's really neutral, that extra money is neutral, right? So we know this equation, P equals M times V bar minus Y bar, which we have from the quantity theory of money, right? So now let's assume that the total money in the economy is $2 trillion. Velocity is 5. And then the total output is $10 trillion. So the price level would be 2 times 5 by 10 equals 1.0, right? Price level is 1.0. Now let's say the Federal Reserve decides, hey, I'm going to print more money. So money supply goes from $2 trillion to $4 trillion. Yeah. And so the price level would be 4 times 5 by 10, 2.0. Meaning the price of goods have just gone up 2 times, 100%. Price level has gone up 100%, right? So let's say my mobile phone was $50 and laptop was $100. So laptop upon mobile will be 2, right? Now, if my price of goods have become twice, and let's say my mobile now becomes $100 from $50, and laptop becomes from $100 to $200, laptop upon mobile now becomes 2 again. Meaning if you see 100 divided by 50 is equal to 200 divided by 100. So the price level didn't really change stuff, right? My purchasing power of mobile versus laptop, my goods, is remained the same. I'm just spending more. So there's a huge learning here, which I think, it's not in the textbook, which is if the Federal Reserve is printing money and if I keep cash in my account, right? Here, I'm going to be spending more money. Initially, I used to spend $50 on mobile phone. Now I'm going to be spending $100 on the same mobile phone when the price level is going up, inflation is going up. So I'm losing the value of my money that's in my bank. So bank money actually loses value when Federal Reserve prints money, inflation keeps going up. So that's the conclusion. Not 100% sure, but that's, I think, what this is telling us. There's also an example in the book on how Zimbabwe government caused hyperinflation in the country. Very recent. What they did, they confiscated farmlands, I believe, which got the output of agriculture to go down. When the output went down, the tax dollars went down. So when the tax dollars went down, the government didn't have money to pay their expenses. And so what they did was they started printing money. And when they started printing money, inflation went up, right? And so that's the reason why they kept printing more and more money for their expenses. But the real thing was this, right? The output equation, the engine of growth was broken. So this is the high-level summary. We know why money and inflation, money supply and inflation is tied. We know what money is. We know the measures of money. Quantitative theory of money is pretty critical to understand how money supply is tied to inflation. And we know from Fisher's equation how inflation is tied to interest rate. We know about costs of inflation now, it's expensive. We know about classical dichotomy that hey, money supply doesn't really change real economy, and then they diverge. We looked at an example of like how potentially the cash in our bank accounts could lose money if inflation keeps going up, right? And we looked at the example of Zimbabwe, right, on how they went through hyperinflation. So money and inflation, interesting